Panic, panic, and more panic.
Something needs to be said about the current state of the housing market.
The 2022 real estate collapse is going to be worse than the 2008 one.
Every major YouTuber and their mom is saying US housing is going to crash. Here's why they're all wrong. They are assuming the upcoming recession will lead to a crash like 2008 or worse. A crash where homes lost a third of their entire value, leaving the entire economy in shambles.
The worst day on Wall Street since the crash of 1987.
The Dow traders are standing there watching.
Whole neighborhoods were emptied as banks foreclosed and evicted homeowners. The problem is, the 2008 global financial crisis was a once-in-a-lifetime event. If we go back all the way to the 1950s, there have been up to 10 recessions. Despite that, there hasn't been a single crash outside of 2008 where housing has come down anywhere near what happened in 2008. Outside of 2008, the worst decline in home values was back in the 1970s. But even then, home values only fell 2.5%. So why is 2022 so different from 2008? Turns out home prices only fall 25% or more when banks are forced to foreclose on homes and sell them at fire sale prices. And that only happens when home values are less than the debt on homes themselves. Turns out this time around, home values are much higher than they were in 2008, all while the debt is about the same as 2008. This means homeowners have much more equity in their homes. So what if home equity is higher than it was in 2008? With home equity so much higher, even if home prices do start to come down and we go into a recession with higher unemployment, homeowners will have enough money in their home that they will want to sell it at the highest price possible, or possibly borrow on the equity that they have in their home and use that money to help them get through financially difficult times. As a result, homeowners are in a much better situation than back in 2008, where because the debt on their homes was higher than what the home itself was worth, many homeowners were incentivized to just abandon their homes along with their debts, because none of their own money was at risk. Given this massive difference in the bank accounts of US homeowners, a slowdown in housing in 2022 will not snowball into a full-fledged crash. Most homeowners will just choose to stay put and stay in their homes with really low mortgage rates instead of trying to move and sell their homes at lower prices. So if there isn't a crash, does that mean it's time to buy? Smart money is betting this slowdown in US housing is the best time to double down and invest more in real estate. Turns out, instead of having too much housing supply like we had in 2008, we've actually been dramatically underbuilding since 2009. On average, we built about 1 million homes every year going back to the 60s. This number fell dramatically after 2008 and has just recovered. But you might say there was already oversupply. There had to be some correction, right? That's true. And we can see that in the inventory of homes available for sale in the United States at this time. But we made up for that oversupply in housing by 2012. Yet we still continued to not build enough homes for the number of people in the United States. You take that and add in the supply constraints led by COVID and the fewer number of homes that were built as a result of the pandemic, you can see why home prices went up 20% last year. Hi friends, Maaiz here. I'm a hedge fund analyst turned entrepreneur, and on this channel, I share the research I'm doing to build my own investment strategies every week. But what about demand? 30-year rates for home mortgages are touching 7% as of last week. Won't that just kill demand for housing and bring prices down? That's true. Demand is pretty bad right now. In places like San Francisco, prices are actually down 7% year over year, and much of the rest of the country has cooled in its price appreciation. And I expect this will continue as rates continue to rise. But despite this massive increase in interest rates leading to housing costing so much more to own, median home prices are up 6% from last year. Last year, which was already a stellar 10% plus year. But looking at the same median sales of American homes, we can already start to see a slowdown in the decrease in prices as a result of the interest rate hikes. Because at the end of the day, as rates go up and mortgages go up, soon the rents will start to follow, making it such that the difference between renting and buying won't be as bad as rents also start to catch up. Really high mortgages don't seem out of place when rents are also really high. You might be asking, but why will rents also go up? This is because the Fed's rate hikes are not a response to a short-term glut in investment. Rather, it's an effort to reduce this persistent inflation as a result of a really strong economy. In other words, higher rates may push home buyers to become renters. And as a result, more renting will lead to higher rents at a time where apartments available for rent are hard to find. So what does all this rate hike talk mean for home prices in the short term? In the short term, we're already starting to see a slowdown in pricing and a decrease in some of the hottest markets. But on average, we're unlikely to see a massive crash. We might see something closer to what we saw back in the 70s, where the prices of homes fell by 2.5% or so. But soon enough, as rents also start to rise, the higher prices will just become the norm, as is in any inflationary environment, where the prices of everything starts to move up and stays at that rate. And the Fed will continue to raise rates until inflation comes down back to its 2% goal. They won't raise rates to a point where inflation becomes deflation and prices come back down. They'll only raise them to the point where they just won't rise as quickly. So the question is housing still a good buy? Surprisingly, in the current slowing economy with high inflation numbers across the board, housing is a solid investment when inflation is rampant. Because housing is a hard asset with a limited supply, making it a great option for protecting your money from being inflated away. In inflationary periods like the 1970s, housing kept up with inflation and outperformed US equities. Though looking at what happened back in the 1970s is useful, that data doesn't take into account the current US housing market, which is surprisingly ripe for major growth. Turns out US demographics are such that US millennials want to buy their first home. Many had been putting off major life decisions like getting married and having kids because of COVID. That is just no longer true. In 2022, the United States had 2.4 million weddings. This is the highest in 40 years. More weddings is equal to more first-time home buyers in the United States. On top of that, unemployment continues to be near all-time lows. Despite a slowing economy, we haven't seen the major layoffs that many would expect at this point. Rather, companies are still having a really tough time hiring for jobs that they still need. The employment backdrop helps support new first-time homebuyers. This massive movement is apparent in the number of subscribers on the subreddit First-Time Homebuyer, which grew from 8,600 subscribers just 2 years ago to over 130,000 now. So we can see that COVID pulled up a lot of this demand, but that's not the only reason we're seeing this major push towards buying homes from younger Americans. Turns out a large portion of the US population will actually be entering the 35 to 45 year age range in 2022, and this trend will continue over the next 5 years. This age range is the peak point at which most Americans choose to create a household and buy their first home. As a result, there's a strong tailwind of increased demand from new home buyers just entering the market, while supply is still constrained as rate hikes make the housing environment really uncertain. But wait, turns out there's even more to this. The last few years has actually seen major growth in a new kind of home buyer. Thanks to Airbnb and the ease of renting out homes, the number of homes that are being bought by investors is up to 33%. As I mentioned earlier, with inflation rampant, many investors are actually looking to buy more hard assets like single-family homes. Now with the ability to rent out those single-family homes easily through Airbnb or other online websites, more and more single-family homes are being bought out just to be rented out later. And given how popular real estate investing is on TikTok and other social media platforms, this trend is only picking up steam. Though real estate does really well in an inflationary period, there's actually one investment that does even better. Check out this video on Warren Buffett's $40 billion bet on this inflation-proof investment.